we are looking at investment in associates and the joint who and the joint ventures. Investments in associates and the joint ventures. So if you remember our numbers, associate investment in associates basically runs from 20% all the way to 49.99, whatever, slightly below 50%, investment below 50%, but of course 20% and above. When we have an investment falling here, then that investment will be called who? An associate, will be called an associate. And then, ladies and gentlemen, we have in this case here a JV, a joint venture. Joint venture, if you remember, this is exactly 50%. Exactly 50%. Exactly 50%. Actually, joint venture, we normally call joint venture Mr. 50%. 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 All right. So very, very important. Ladies and gentlemen, here for these two, we normally use what we call equity accounting. Equity accounting. Equity accounting. And this equity accounting, how does it go? How does it work? So equity, the increase in profits here, or of course, decrease of the same. So equity accounting will take, for example, investment in associate. So we have an investment in associate, at reporting, in associate, or joint venture at reporting. It will be the cost of the investment. The cost of the investment, we take it like that. We add PAP. Of course, in this case here, percentage, our percentage here. So times our percentage share. Could be 20%, could be 20%. So we add like that. And then we less, in this case here, UPS. We less UPS when it is downstream, the opposite of the other one, when it is downstream. So remember this, again, UPS, we only take our percentage and we less like that. UPS is unrealized profits on stock, unrealized profits on stock. And then we shall be able to come here and the less what here? Any impairment loss. Impairment loss in associate. In associate. So this one, we normally take the full figure given. You can't apportion because you see, will be told that your associate has been impaired by 10,000. So you can't say the 10,000 loss is fully yours. So you can't tell me that Mwalimu use what here a percentage. No percentage shall be used. And the moment you do those 4 items, then we'll be able to get here what we call investment in associate, investment in associate, investment in associate, investment in associate at what year? At reporting. Investment in associate at reporting, like that. Investment in associate at reporting. So we call it the equity accounting approach. Equity, where we look at just profits and losses. So where do we begin from? We bought this at, say, 80,000. Then there is a share of post-acquisition profit. Then less UPS. UPS, if it is this parent, the owner, the investor, who sold goods to the associate. So downstream, remember, downstream happens like this. So we have here parent, we have here subsidiary. Allow me to bring the associate here. For the associate, the parent will be called investor. Investor. So remember, when the sale is down, when the sale goes like this is called downstream. Downstream. If it goes up like this, from these ones here up, it's called upstream. Upstream, like that. Upstream, like that. Upstream. So we have here downstream, and what we call upstream. Downstream and what we call upstream, upstream, upstream. All right, so ladies and gentlemen, up to here, I'm so sure you have seen lots of dust. Let's, in this case here, put everything into context here to try to understand everything by looking at one question from the revision kit, from this ACCA revision kit, from the ACCA revision kit, and this is what I would want us to do. It's question number 39. Preparation question, Laurel. Which reminds me, some time back, I used to pronounce this word very, very bad. Very bad, this word. You know, some of these things are quite, this one here, for ladies. Very few students will be able to know how to pronounce this. Do you know how to pronounce this yourselves? Do you know how to pronounce it? There is Barbara, there is this one here. Very few. It's Laura. It's Laura. Sio Laura. Sio Laura. Sio Laura. When you pronounce Elsa Keka Raura, it becomes very, very sad. Very, very sad. It's Laura. Page number. Page number is very important. Please write there. So you're writing there ACCA revision kit. ACCA revision kit. Page number 44. Page number 44. Page number 44. And then you write question 39, Laurel. 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 I want us to move very slowly here. Of course, your examiners use these associates here to really punish our students in the past. They shall not punish us this time around. This time around, there is no ninja who will be injured in an exam. This time around, if we are going to our exam room with our 6 high-heeled shoes, after the exams, we shall be able to walk majestically, comfortably. No wounded ninja, because the preparation is going to be great. We're going to prepare in a big way, in a big way, in a big way, in a big way. Great. Great. Thank you. So we are told here Laurel acquired 80% of the ordinary share capital of Hadi. So with 80%, what will be the name of Hadi in our books of accounts? What will be the name of Hadi in our books of accounts? With 80%. Page, it's 44, page number 44. Yeah, it's a subsidiary. Thank you very much. No, not parent. Parent is, sorry for that. Parent is Laurel. The investor is the parent. And then Hadi now becomes the what here? The subsidiary for 160 million. And the 40% of the ordinary share capital of Comic. So 40%, please look at the ranges. Look at the ranges. So in this case here, Comic becomes who? Comic becomes who? Look at the ranges, 20 to 49.9999. So Comic becomes who? Comic becomes, yes, it becomes an associate. It becomes an associate. So when the retained earning balances were 64 in Hadi and 24 in Comic, Laurel, Comic, and Hadi are public limited companies. The statements of financial position of the 3 companies at 31st December X9 are set below. So remember, according to IFRS 10, we only consolidate the parent and the subsidiaries. We don't consolidate associates. So in an exam, I would have struck this Comic column. When I'll be consolidating, for example, if it's PPE, I'll take 220 plus 160. I can't add 78. Because 78 is not ours. You're not in control of Comic. Comic in this case is an associate. The assets of my cousins are not mine. The assets of my cousins are not mine. I can't really count them. My cousins, you know, it's about nuclear family. Nuclear family, that's when you can control. You can control that. All right. So you're also given the following information. On 30th November 20X9, Laurel sold goods, blah, 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 blah. So, ladies and gentlemen, the first thing that we need to do in this kind of a question is to draw the group structure. So we have Laurel to Hadi and to Comic here. Laurel, Hadi, and a Comic. So we have here Laurel, Hadi, and a Comic. So we have Laurel, Laurel, Hardy, and Comic. Laurel, Hardy, and Comic. So we have here Laurel, who bought 80% of Hardy. And then they bought 40% of Comic. So then this 80% is controlling, it's more than 50%. So this is a subsidiary, and this becomes what your 40% is in between that 20% to 49.999. So this becomes an associate. Very important for you to come for both to give us the date of acquisition and the date of the financial statements. Very, very important. The same date of acquisition and the date of financial statement. Just give us these two. They are very, very important. So when was Hardy acquired? Is there somebody who is able to see when Hardy was acquired? Is there anybody who is able to see when Hardy was acquired? First of something. When Hardy was acquired, the date of acquisition, first of something. So you can see here that Hardy was acquired on 1st January X7. So this is 1st January X7. I call it 07. 07. That is Hardy. 1st January. And then we have Laurel that was acquired. Laurel was acquired. Let's see, were they acquired on the same date? Let's read again. So we are told that Laurel acquired 80% of the ownership share capital of Hardy for this and 40% of the ownership share capital of Comic. Both of them were acquired on the same date. This must be a strong company. Same date. So in this case here, we have first 07. How about the date of the financial statement? The date of the financial statement. So the date of the financial statement is 31st December 09. 31st December 09. So 31st December. 31st December 09. Right. Now, how many years do we have? Of course, this we can only talk of years, the same. How many years do we have in between acquisition and the date of financial reports? So we have the whole of 07 because it was beginning of 07. So the whole of 07, the whole of 08, and the whole of 09. 3 years. 3 years. So, ladies and gentlemen, again, it will be very important for us to ask ourselves, this examiner, is he gracious enough to give us retained earnings at acquisition? Is he gracious enough to give us retained earnings at acquisition? Is he gracious enough? You know, some examiners are very gracious. Some examiners are very gracious. They always give us retained earnings at acquisition. Oh, yes. When the retained earnings, you can see, was 64 in Hardy and 24 in Comic. So retained earnings at acquisition, 64, and then retained earnings at Comic were 24. Great examiner. Here I'll get all the marks. Now, ladies and gentlemen, with this, then I'll go ahead and lay down the pro forma. Remember, this is even the method recommended by ACCA. You can see the pro forma solution. And you see ACCA, they have done research here. They're telling you don't do calculations fast, or rather workings fast. If you do workings fast, I will teach you again come next semester this paper. I don't want to teach you this paper. I would want us to be best of friends. I mean, you know, best of friends means we must have the upward mobility. I'm teaching you this time round, you pass straight away, you go to BDA. So always start with this. You simply write this, the pro forma concept here. They're telling you even write without even anything here. No, don't place any figures. Don't do any workings. So in this case here, then you'll come and just look what they have here. Like now we have none. Actually, you can even take the approach. Like now we have non-current assets. So we have here, the name here, the name of the group is, you always call it by the parent name, Laurel Group. So it's called Laurel Group. So Laurel Group, so we're writing here, non-current assets here. So Laurel Group, of course, a statement of financial position. Statement of financial position as at 31st December 09, and then you underline. 31st December 09, and then you do what year? You underline. You underline. Let me see the comments first. It's very important for teachers to see comments. Great. Thank you very much. No question. Great. Thank you very much. So, Laurel Group, statement of financial position as at. So you come and give us here non-current assets. Non-current assets. So non-current assets, what do we have? I can see we have property, plant, and equipment. Property, plant, and equipment. I will not even pick any figure. I won't pick any figure. So PPE. Right? Do we have any other non-current assets? We have investments. These investments, of course, are broken down into two. These investments. You know, these investments are what year? We have subsidiary at 160. And then we have, we invested in an associate at 70. So 160 plus 70 is how they got this 230. So these investments are broken into two. So we have investment in a subsidiary. We shall never have investment in a subsidiary in our books here. So instead of investment in a subsidiary, we replace it with what? Investment in a subsidiary, we replace it with what? Investment in a subsidiary, there is a name we bring. Remember we said investment in a subsidiary is investment in yourself. It is goodwill. So investment in a subsidiary, you place that with goodwill. And then, of course, we have here investment now in associate. This one you must bring it. Investment in associate. That is the end of non-current assets in this question. Then you come and give us, of course, you must leave some space just in case something crops up. You leave some space, so we have current assets. So you just do a pro forma, always do a pro forma. So we have current assets, you only come and pick them. So you pick them. So you have inventories, receivables, and cash at the bank. So we have inventory, inventories, receivables. Then we have cash at bank. We have cash at bank. So that is the end of our what year, our asset section. So leave some spaces, of course, things will crop up. You must be very generous with space. So we look at financed by. So financed by, I start with equity. Equity. So equity, of course, we have share capital, and then we're going to pick share capital of the parent only. Could you kindly give me the equity components that you know will have to feature in our financial statements? Of course, you look at what, first of all, you have. Before adding anything, you look at what you have. You're being guided here. So we have already share capital. We have share premium. We have share premium, share capital. We have share premium. We have share premium. After share premium, we have retained earnings. So these three are there already. But there is a new baby coming here. There is a new baby. There is a new baby coming here. There is a new baby coming here. There is a new baby. There is a new baby coming here. There is a new baby coming here. NCI, yes, NCI. So we have here non-controlling interest. Non-controlling interests. So non-controlling interest like that. So we are looking at financing of these two total assets, equity, that's okay. From there, we go to the liabilities. And liabilities, we shall always start with current liabilities. And current liabilities, you underline. And current liabilities, you underline. So non-current liabilities, of course, you must leave space. My board is not that big. For you guys, you have got acres and acres of what here? Empty spaces there. Acres and acres, I know that. So, do we have any non-current liabilities? Seemingly no. No, no. So you simply jump to current liabilities. So for me, I'll only come and there, just wrap this word none. I hope you can also just strike it out. So we are left with current liabilities, of which you only have one item called payables. So you start by giving us the pro forma, because ACE is here with their wisdom. They have known that students who go straight away to workings, they always get very minimal marks. Once you start looking for net assets, goodwill, you'll get very minimal marks. So once you have done this pro forma, I don't know whether you're together. Have you guys finished writing up to where Mwalimu has reached? Have you guys finished writing up to where Mwalimu has reached? Great. Thank you so much. Great. So then we shall be able to come and pick this generally. So we have here property, plant, and equipment. So property, plant, and equipment, I will take 220 plus 160 plus 78. Please write like that. So for PPE, I'm consolidating, I'm writing things together. So I will write 220 plus 160 plus 78. Am I right if I say like that? Will I be right if I say like that? Will I be right? No. Thank you so much. You guys have been able to see my stupidity there. I'm stupid there. A little bit, of course, in quotes. Comic is an associate. And we don't consolidate. We don't consolidate line by line. Associate things. So actually in an exam, this, you should be able to use a pencil and a cover here so you don't confuse. Comic should be covered using just a pencil there. Usikave na nguvu sana alafu kosa kuona figures. Just using a pencil mark, you strike this off using a pencil. A pencil. A pencil. Iko mwenye anakuwa na chuki na associate na cancel kile kilafu baadaye kitaka kuona figures size akaona figures. All right. So the property, plant, and equipment, it will be 220 plus 160. So it will be 220 plus what here? 220 plus 160. Do I pick up a calculator now? No. We are still trying to fill in a pro forma. Later on, when we go to the notes, things are going to change. Things shall change. All right. So then we have goodwill, that one we need a working. We have an investment in associate, that one we need a working. So we go to current assets. I can see inventories. So inventories, I'll add here 384 plus 234. 384 plus 234. 384 plus 234. Inventories here. 384 plus 234. Are you able to see figures for receivables, somebody? Are you able to see figures for receivables? Okay, great. Figures for receivables. Oh, yes, we can see figures for receivables. So for receivables, ladies and gentlemen, we have 275 and 166. 275 and 166. 275 and 166. Thank you very much, Mary Ann. 275 and 1. I don't want to keep on putting up that book. Give me the cash at bank, the figure for the parent. Remember in group consolidation, I'm just reminding you guys, in this group consolidation, we normally take parent plus sub. Parent plus sub. Parent plus sub, eh? We don't bring in an associate. An associate ni kama mpango ya kando. Don't bring them in. You bring them in, you bring problems. You bring problems. You bring problems. So mother is 42 plus 10. 42 plus 10. 42 plus 10. Like that. 42 plus 10. Like that. Then we go to share capital. So share capital, will I take parent plus subsidiary? Share capital, Mary Ann is telling me, Mwalimu, no, share capital shall always be the one of what here, the parent. And I like this question because this question does not have share acquisition. We never gave out our ordinary shares. This question, ladies and gentlemen, we bought cash. So there will be no adjustment here. So in this case here, share capital, I'll only take the one of what here? Share capital, I'll only take the one of the parent here. So share capital, I'll only take the one of the parent here. For share capital, I will take the one of the parent, of which Mary Ann is giving me a figure of 400. Parent only. I love this. 3 marks. 3 marks. Share premium, parent only. Parent only. And remember, for any tick that you get here correct, it's always how many marks? 2 marks. For any tick. So here already you have 2 marks. And these 2 marks are very many. They can make you see places that you've never seen before. Another 3 mark is for this share premium. Are you able to see the share premium parent only? How much? Share premium parent only. How much do we have there? 16, right? Okay, that figure is very small. Why did they give us a very small premium, these people? They gave us a very small premium. 16, yes, you're right. 16, you're right. So in this case here, we have share premium, 16. Now, retained earnings, non-controlling interest, later. Later, we need workings for those. Payables, I can see something here. Payables, I can see something here. So are you able to see payables figures I take? Yeah. Payables, I need figures here. Give me what to take here. Parent plus subsidiary. Parent plus subsidiary. 457 plus 343. 457 plus 343. Like that. 457 plus 343. Now, ladies and gentlemen, from there, I'll be able to look at those fast, the quick wins. The quick wins as a ninja. Where in this case, here, I'm able to strike these guys, perhaps the eyes, etc., etc., to be able to win here very fast. The quick wins, of course, I know there is revaluation what here gains, or revaluation losses. I know there will be the thing of what here UPS, only 3 UPS, and I know there will be something to do with what here intra-owings. And then, of course, if the examiner wants to confuse me a little bit, he'll give me either cash in transit or goods in transit. Statement of financial position haina adjustments mingi. Wanafunzi waogope kitu bure. Haina adjustments mingi. So hapo unaziangalia kama sio unatafuta note ambayo inaongea kuhusu revaluation gain. So revaluation gain while we are taking share capital and the premium directly. Very good question. Remember, here we are basically looking at what here third-party contributions. We can't invest in a subsidiary and then we say that subsidiary investment to be reported here. No, this is an internal arrangement. And I gave you a very good example. For example, when I pay school fees for my wife, that I can't be taking that really as a very, very, no, that's investment in myself, right? So when you invest in a subsidiary, that is an investment in self. Remember, you're looking at this organization as one economic entity. The group is one economic entity. So anything that you're doing, that's why we never said here, investment in subsidiary. So this investment is canceling out with the share capital and the share premium of the subsidiary. For here, you can just cram share capital and share premium. You take the parent figures only and it will be sorted out. Great. So let's look, for example, for here, I will look for any revaluation note. So revaluation notes, what do we have here? Revaluation notes, what do we have here? Revaluation notes, ladies and gentlemen, do we have a revaluation note? So I'll pick them very fast. I know how to pick them. Within 10 minutes, I'll be through with this. I'm told here, like now, this is UPS. This is UPS. Look at note number 2. On 1st January 07, Hadi owned some items of equipment with a book value of 45 million that had a fair value of 57. So you can see book value is lower, fair value, market value is higher. What is this revaluation gain? Is there somebody who can give me this revaluation gain? Anybody who can give me this revaluation gain? Because you see it's a gain, because the book value is lower and the market value, which is the fair value, is higher. So 57 minus 45 gives me what, somebody there? 57 minus 45 gives me what figure? Yeah, 12, isn't it? So that gives me 12. That gives me 12. That gives me 12 years. So what do we do with this revaluation gain? What do we do with this revaluation gain? It's a gain. Yeah, we add to PPE. We add to PPE. So we're going to add it to PPE. We add it to PPE. So we say here plus 12. And then, of course, we less its depreciation. So we less depreciation. But now here, I'm so sure out of these 48 students or 49 students, it's only one student who will be able to get that depreciation amount correctly. And I will need to even reward that student. Only one student will get depreciation figure correctly. Let me give you a chance of doing it. Only one. I'm not saying that you're stupid, but only one person. Only one. All the other ninjas, in this case, here will be wounded. Wounded ninjas. So I'm giving you 1 minute. You try out of this. These assets were originally purchased by this and are being depreciated over 6 years. Over 6 years. I'm not saying anything. I'm just waiting to see whether there is any ninja who will be able to get this depreciation correctly. And please don't be, sorry for using this word so many times, it's quite sad, but don't be stupid to go back to the answers. You're trying to fight hard here. Don't go back at the answers already. No, that will be very sad at this level. That will be very, very sad. Just try, even if you get it wrong, so what? So what? So long as you've tried. And remember, this subject, the winners, will be those students you are seeing. And I would want you to mark their names. Those students who are seeing that they are giving figures every now and then. Those guys will pass. In Zoom, you can't take a back seat. And like, the other day, there's a student who came to me, Mwalimu, how comes I'm failing this FM for the 7th time? This 7th time I came to you, I thought I would pass. Nikamuuliza kwa class ulikuwa ukiongea ati hapana. Nikamwambia semester anza kuongea and I'm 100% sure atapita. Usione kama watoto wanaongea pattern wajinga, hapana. There is always grace for that. It makes you to be very active. Very active. But when you are just taking a backbench position, you are a candidate to repeat this paper. I'm your father now that you wished me happy belated Father's Day. I must tell you the truth. The only price you have to pay is to give those answers and ask questions. Ask questions. Be happy. Be happy. And you'll come to tell me, anybody who gives answers often, hawezi akaanguka. And then, of course, there is the concept of also reviewing after class. After class, you must also get time, like when you are very busy, during lunch hour, when you have some time, like 30 minutes, you simply look at a question that you've done in class. A question you have done in class. You can't go wrong. You can't go wrong. Thank you so much. I can see so many chats here. Depreciation, somebody, Mary Anna's gotten 10. Accumulated depreciation, great. 2. We have here 6, 210. PP Marvin has been able to give me the total figure. Perhaps she'll be right or wrong. Paul gives me 9. Yeah, I'm not surprised. It's only Paul who got this figure correct, the 9 figure. I'm not surprised that I can't blame anybody. It's normally not an easy one. Not an easy one. Thank you very much for trying. So give me 1 minute. I do this question. And then all of us will be very happy. 1 minute. I do this question. So you see here, you are told here, these assets were bought some time back on 1st January, X5. 3 dates that are very, very important here. 3 dates that are very, very important. 3 dates that are very, very important. So we have here, they were bought on 1st January 05. We have here the date of acquisition. We have here the date of financial statements. So we acquired this on 1st January 07. The financial statements are 31st December 09. So from the time we purchased these assets, ladies and gentlemen, from the time we purchased, remember the total life. The total life of the assets is 6, they have told us. Total life is 6. Lifespan is 6. Is 6. And from the time, 6, it is 6 from here, 6 years from here. The lifespan is 6 years from here. And by the time, in this case here, we are doing a revaluation, how many years have lapsed here? This, by the time we are doing revaluation, the whole of 05, the whole of 06. Don't count the whole of 07 because 07 is at the beginning. So in this case here, we have a time lapsed. Time lapsed is 2. So then the remaining useful life is how many years? It's 4 years. Please write this in full, remaining useful life. We start counting the remaining useful life on that day when we revalue. From this date now, after evaluation moving forward, the remaining useful life is how many years? 4 years. Only 4 years. Because the total lifespan was 6, and by the time you're doing the evaluation, there are 2 years that have lapsed, gone. So the rule, the remaining useful life is 4 years. The remaining useful life is 4 years. Remember, whenever you want to get depreciation per annum, you always take, in this case here, this fair value adjustment. You take the fair value adjustment, you divide by the rule. The fair value adjustment, you divide by the remaining useful life. So the fair value adjustment that we have here, you guys have given me a figure of 12, divided by the remaining useful life of 4. So this gives me 3 per annum. But remember now, this has to be accumulated for the time that we have been with this asset. Remember, we acquired now this asset on 1st January 07. So this has to be accumulated to the balance sheet date. To balance sheet date. it must be accumulated to balance sheet date. And they're the ones who told me, Mwalimu, 3 years, from the time of acquisition to the date of the balance sheet. Time of acquisition to the date of financial statements, we have 3 years. The whole of 07, the whole of 08, and then the whole of 09, 3 years. And therefore, the total depreciation, therefore, the total, which is the same as, it will be 3 times those 3 years, which in this case here is 9, which in this case here is 9, which in this case is 9, is 9, is 9. And this is very popular because at your level, I know, your examiner will not just tell you that these assets, they'll tell you these assets were acquired some time back. Whenever they're acquired some time back, please remember these 3 dates. They're very important, very important. So the total depreciation here should be 9 by 7. And then that is the end of this PPE. I can now go ahead and post the final figure here. I can go ahead and post the final figure. That is the end of PPE. I can go ahead and post the final figure. I can go ahead and post the final figure. We shall overcome. We shall overcome. We shall overcome. So what is the final answer here, Paul? What is the final answer here, Paul? Yeah, and this you have to practice. If you see all your questions in your past papers, most of them, they tell you that the assets were acquired some time back. Don't forget this rule concept, remaining useful life. Remaining useful life, 383. Now, if I'm the one doing this, of course, there is no really order. There is no order. It depends on how I wake up, which side of the bed I wake up from, all right? I will straight away move now to the UPS thing. I'll move to the UPS thing. So the UPS thing, I would want to, today, by the way, you should be able to give presents, although now you'll have to wait because today I don't have M-Pesa. I don't have M-Pesa today, but I can get M-Pesa at around 9. So now I'll mark students that I'll give M-Pesa. So the first one is Paul. The first one is Paul. Paul, I owe you. I owe you something small like 500 shillings, not bad for a young man. Great. So in this case, I would want to see people making adjustments for UPS. Oh, Paul and Paul Manotti, great. We shall overcome. Today, nowadays, the polls are very nice. The polls are very nice. So now from this information, is there somebody who can give me the UPS amounts to put in my balance sheet? From this information here, not one. So you give me the figure of UPS, and you tell me where to subtract that figure from, because it must be subtracted. It's fake profits. It's fake profits. I got very good feedback. I never knew that this is a very, very important thing. We keep on learning everything, these things every day. I got very good feedback from Veronica Katunge. Veronica Katunge, I met this lady, was it on Saturday? Yeah, Saturday, we had this welfare. We're trying to come up with this RCM welfare thing. And then she told me, Mwalimu, when you give us these questions to try first, we understand better and we feel very nice. That's what she told me. Yeah, we understand better. So I want to take this approach moving forward. And please, whenever you have got any ideas, I'm a man, in this case, who believes in what here? Corrections, improvements. I thought that when I do them like blah, 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 myself very fast, I thought that's the best way, but I was told, no, when you give us these things to try, they make more sense to us. We would rather do just one question, but we understand it very well. So should the concept work, then you guys owe it to Veronica Katunge. Although nowadays she also doesn't give me figures. Yeah, I'm really worried. When I see students not giving figures, really, this, disturbs me because I know the consequences. They give me goosebumps. When I have students who don't like when I look at your names, like there is somebody who has never spoken to me 100%, it gives me Not one, not two, not three. Goosebumps. I can see them because I know the consequences. At the lower level, you would have passed without really participation. But at this level, higher level of here we are testing evaluation skills, understanding. So here we are colleagues. You should be able to come and tell me, Mwalimu, I'm getting 0 there. So what? I mean, in the process, when we correct you, you understand. We understand. I can see 2 charts. So add 22 to inventory. Add 22 to inventory. Paul, don't you think this suggestion of yours is going to cancel your gift? First of all, add. For balance sheet, the rule, trial, great. The rule, this fake profit in the balance sheet, you're subtracting UPS. But at least you've tried. And I can't, of course, cancel the present. I can't cancel the present, because again, that will be stifling creativity. Add 22 to inventory, less 5 million. Great. Thank you so much, Timothy. Tekla Shiro is very, very active. Less 10. From where, Tekla Shiro? You're trying to hide something here. You don't know where you're going to less this from. You don't know where you're going to less this 10 from. From inventory, yes. Kizungu for cash had originally cost. Imagine si kizungu hii. So nasema on 30th November, Laurel sold goods to Hadi for cash for 32. So that's the revenue that Laurel got. These goods had originally cost 22 million and none had been sold by the year end. I know what brings problems. I'm 100% sure that there is somebody in this case here who is trying to do the UPS this way. That UPS is profit margin. Is profit margin times remaining intra sales. Hapa hakuna haja hiyo maneno. Hapa tunajua umepatiwa revenue. We know it's revenue. Hapa it's revenue minus cost. Hujapatiwa mambo mengi hapa. The revenue these guys generated was 32 and these goods had cost them 22. So profit ni ngapi somebody? How much is the profit? Profit is 10. And none of these goods had been sold. None of these goods had been sold. None of them. All these goods are really with us here. All these goods are with us here. All these goods are with us here. So all of them fall under what we call unrealized. If they told us a half of the goods had been sold, I would have multiplied the 10 with a half to know how much profit you have not yet realized. Here, none of them has been sold. All these goods are still well within our inventory. All of them. All of them. And remember what we said. Whenever we get unrealized profits, we shall add it, Paul. We shall add this to cost of sales and subtract from group inventory. Subtract from group inventory. So go to your group inventory, and say minus 10, and say minus 10. Minus 10. Now, if I may ask, Mother is asking a very good question here before I ask mine. What is wrong using, in this case here, profit margin? Very good. Nothing wrong. But of course, we'll take a longer route. This is what Mother wants us to do. This is what Mother wants us to do. Mother, first of all, she's a bright lady. She's telling us, Mwalimu, get profit margin. Calculate profit margin. So it'll be profit over what year? Over sales. So the profit that we have realized is 32 minus 22. So the profit itself is 10 over the sales of 32. So this is the profit margin. Very good. That's the profit margin. Now from there, we have then the UPS. I don't want to change this percentage because it would really be a very ugly figure. I would rather leave it like that. So the UPS here will be profit margin times RISPAR, remaining intra sales, times remaining intra sales. So profit margin here will be 10 over 32. So remember the intra sale was 32 and nothing has been sold. We haven't sold anything there. We haven't sold anything out of this 32. Everything is within the group. So remember, this is remaining intra sales, nothing. So then these will end up being 10 over 32 times 32, which will end up being what here? 10. So very good method, a bit longer, yes. And then number two, of course, there is a very big chance of you not getting it right. In an exam situation with a little bit panicking here and there, you may not be able to get this process right. I mean, Martha, why would you just go to all this? And you as an accountant, mother, you know that profit is just revenue. How much was generated? Revenue 32. What was the cost? 22. Then I'm able to see my profit. Why would I want to go through all this? But at least I've given you the two methods, and there we are. There we are. Now, I saw in this case here, Mary Ann saying that Mwalimu subtract the 22 from wherever. You know what you're telling me to subtract from receivables is really good. Is really good. But you see now here, was this amount really, I mean, is it an intra owing? You've even seen in the question, you've been told that it was a cash exchange. So it's not like a liability within the group. It won't be a liability within the group. Remember, you only subtract liabilities within the group. Perhaps in this case, if this 32 million wasn't paid, at the end of the day, it's outstanding, then I would have said, Mwalimu, this is an internal owing. Go ahead and do what here? Go ahead and subtract. Go ahead and subtract. This one we have not been told. I don't even think whether there is any provision for any internal owings in this question. No internal owings in this question. Because you can see the goods were sold in this case here for what here? For cash. Now it has now become even sweeter. This thing is very good. This thing now is very good. This thing is very good. Now the group policy is to measure NCI. I'll come back to that. Cumulative impairment losses, I'll come back to that because that is goodwill. So now we go to the next big thing. Now we are going to the workings for the things that we said we are not going to do them immediately, we shall be doing them later. And remember, all those things you have said, working to be done later, all of them are dependent on now this big working called net assets. The big working called net assets. But now, listen and listen to me very well. I'll give you a secret here. Let me give you a secret here. When you go to an exam, and then you see they have given you 10 marks for consolidated statement of financial position. How many marks? 10. This is how we mark this question. If they give me 10 marks, this is how we mark this question. Could you kindly give me this figure of inventory? Are you able to give me the inventory's figure? Inventory's figure, 384 plus 234 minus 10. Let's give me a figure right here. 384 plus 234 minus 10. Please give me a figure right here. 608. 608. There will be no any, there are no any inter-owings, so receivables, you take this plus this directly, give me a figure, right? 275 plus 166. So no adjustments to receivables, no adjustments to payables. So in inventory, that's okay. Now receivables, 441. So this is 441. From there, we have cash at the bank, that's 52. 52. From there, we have payables now. Payables. 457 plus 343. Mm-hmm. 457 plus 343. 800. 800. So remember, if you look at your answers, this is correct, this is correct, this is correct, this is correct, this is correct. All right. And it is any tick, any correct, any tick at 2. So 1, 2, 3, 4, 5. So this is 5 times 2. I've exhausted all my marks. And any other work that I'll be doing now subsequent is irrelevant. Is irrelevant. Unless I have the time. If I have the time, ladies and gentlemen, then I'll be able to go ahead and do what we call the net what here. Net. If I don't have the time, actually, if I'm the one doing this, I'll just finish this question here. And then I go straight away to a cash flow question. Because most of you tend to waste a lot of time here because you find this question to be very sweet. You're wasting lots of time here. And yet you have already gotten your maximum marks. You know, you can't push the ceiling higher. If it is 10 marks, it doesn't matter what you're going to do subsequently, it is 10 marks maximum. And remember, the maximum number of minutes you have per question are what here? 37. But because you are learning here, and again, there is also another fact here. I may say that I'm not teaching you how to get net assets, but at times you go and get the examiner asking you question 1, get the net assets of this particular subsidiary. Get, in this case, the goodwill of this particular subsidiary. So I have to teach you, but in an exam, be cautious. Caution here. Always know that each tick is 2. You can easily even mark for yourself. You can easily mark for yourself. And if you have to push it a little bit further, then just do the net assets and what here and the goodwill. Leave it. You have to push it a little bit further. Do the net assets and goodwill. Even myself, I'm quite a fast person in terms of writing like this. And I know once I do my net assets and goodwill, I'm now doing 40 minutes, 40 minutes and above. And trust you, ladies and gentlemen, I've marked these things for so long. If you take 1 hour, like now 20 minutes doing one question, do you know what will happen? If you take 1 hour and 20 minutes here, even 1 hour doing one question, you're going to fail terribly. You're going to fail terribly. AFR, financial reporting, financial accounting, it's more of time management. How you manage time is the most important thing. All right. So now net assets is yours. I've already finished, doing this. I've already finished doing this. So I would want you to go ahead and do the net assets for me. Please do the net assets for me. The ninja who gets this should be able to get a present, isn't it? Oh, sorry. There is something here. On the same day, Laurel also sold goods to Comic for cash for 22 million. These goods originally cost 10 whatever. You see, this is Comic. Comic, in this case here, this is an associate. All this information about associate, in this case here, are what here? Their noise in terms of group consolidation. We shall handle this later. And then Mary Ann is asking whether this 22 million, if it was not, that 2 million, if it was not for cash. For us to take this as an intra-owing, the examiner must tell us expressly that this is an internal owing. Don't subtract. Don't subtract. The examiner should have put an extra note telling us that there is an internal owing of, say, 32 million between the group. Otherwise, always assume that everything has been paid up, unless the examiner tells us that there is an internal owing. There's an internal owing. All right, now we are doing the net assets. Abracadabra. Let's see. Yes, abracadabra, net assets. Ukipata hii ushajua consolidation yote 100% net assets. So net assets, I've just shared, this is the most important part. This is the most important part. Please, everybody's doing that work. Everybody's doing that working. Everybody's doing that working. Everybody's doing that working. I can see answers have started coming by, which is very good. Even if you get it wrong, trust you me. I love bold students who are able to air their opinions, even at the workplace. If you want to grow very fast, when you go to meetings, so long as you're prepared very well, always talk, give out your ideas. What do we do for the company to grow? Give out your ideas. So Paul tells me DOA is 220, DOF is 200, DOF is 200. Thank you, Paul, for trying. DOA is 220, DOF is 2. Mary Ann, DOA is 163, abracadabra, 163, and then 230, date of reporting or date of financial statements. Good trials, and I mean, I'm happy. According to Sylvia Nkova, DOA is 224 and 227. 224 and 227. Nobody's right. But by the fact that these students have tried doing the question, these guys will get a better understanding than those ninjas who have decided to take, in this case here, a backseat. Thank you, Tekla. Shiro, 531. 531. So I'm waiting for 5 more, And I'm so sure I'll be able to get them. I'm waiting for 5 more. So we have Leonard at 220 and 230. Seemingly 220 is very popular, right? HP, DORA is 176. Date of financial statements 240. Thank you very much. Patrick, great. 132. DORA 220. DOF 230. 220, 230. 220, 230. Daniel Angaya, 220, DOA. At least you have one. Great. DOF 230. DOF 230. 175 and DOF 230. That is the first correct answer. That is the first correct answer. Both of them. That is the first correct answer. I like this. And of course, I appreciate everybody who has tried here. I missed only one part. Quinta, thank you so much, but you have something wrong there. And once we do this, you will be able to see where you went wrong. So I'm counting now, it's 3 more before I close the chapter here. How I wish those answers were coming like from the day when I ask a question and then I get like all the students giving me a response. That is the day I'll take my first beer. No, I can't take beer. Beer is not good. No. You lose out a few things, Paul. Even if the PAP is still 55, it's good to do the correct thing. Correct entries. Correct entries. All right. So I'm still waiting for this more answers. Even if they are wrong, I mean, I don't care. What I know with my years of experience, the more the mistakes, the more the learning. This Holy Joe attitude is not the best. Holy Joe attitude is not the best. It's pretense. That's called pretense. Holy Joe attitude is called pretense. Doa 220, Dove 261. Thank you, mother. One more. Joyce stuck. But at least you've tried, Joyce. You know, that's very good. You've tried. You've tried. You've tried. Thank you so much. So then let's do it together. Let's do this to 20, at least when I figure the number I wanted. Thank you so much. 220. And then we have in this case here, 200 what here? Yeah. Sasa, because I'm sharing the screen here, I just have to write it from here. Oops. So then we have, ladies and gentlemen, our net assets here. We have our net assets. So our net assets at acquisition and at reporting. So of course, this is at DOA and this is at DOF. At DOA and at DOF like that. Stranded on the way, we shall overcome. We shall overcome. We shall overcome. Quinta, are you trying to show us something or what is happening, Quinta, there? Let me just shut the video. All right. So at acquisition and at the date of financial statements. Thank you so much. So in this case here, we start with share capital. Remember, it is the equity components. So share capital, do we have a problem with share capital? I doubt. So share capital, remember the share capital for the subsidiary. These are net assets of the subsidiary, by the way. These are net assets of the subsidiary. Subsidiary is Hardy. So then share capital, it will be 96. So please write here, net assets of the sub. Just confused. So share capital never changes, 96. Is that okay? Share capital, no change. Thank you so much, 96. Then we have share premium. We have here share premium. So we have here share premium. So share premium, what do we have there? Because it's also an equity component. It is 3, no change. So 3, no change. Then we have retained what here? We have retained earnings. If you remember, at acquisition, we wrote retained earnings at acquisition. Are you able to remember the retained earnings at acquisition figure? It was 64 for the subsidiary. For the subsidiary. At acquisition is 64. This is a funny one. These dances. So 64. And then how about at reporting? At reporting, what do we have there at reporting? 120. You guys are giving me very correct answers and yet you missed. Then we have fair value adjustment. Are you able to remember the revaluation? Fair value adjustment. It was again 12. Do we have a change? Do we have a change for fair value adjustment? It is 12 and 12, no change. And then, of course, these are depreciable asset. So we have depreciation on fair value adjustment. Which was what here, somebody? Alafu unajua, hawezi ukaweka depreciation. Wewe, nguo ikiwa mpya kabisa hapa sasa. Hapa, atakuja huwezi ukaweka jameni. Huwezi ukaweka depreciation kusema tu ukweli. Huwezi ukaweka depreciation. Hiyo unaweka ngoto mahali pamoja tu, which is 9. How did we get 64 for retained earnings? Joyce must have come a little bit late. Because we said here retained earnings when we acquire. So acquired Hardy for 160 and 40% of share capital of Comic for this. When the retained earnings here was 64 for the subsidiary. I hope Joyce this is helpful, 64. Actually, we wrote this in the diagram. It's given the question, yes. Are you able to see that, Joyce? Thank you so much. And that is it. So come here and give us, in this case here, our total figures. Give us our total figures. So then you'll be able to see the total here is 175 versus what here? Versus 230. So in this case here, it is one who got this. Explain, okay. It's one who got this correctly. It's one who was the first, So retained earnings for DOF 128. Marvin, this is very easy. Because you see, Hardy is a subsidiary, and at reporting, we have retained earnings here. at reporting retained earnings of 128. Are you able to see this? You see at DOF, DOF is date of financial statements, date of acquisition. So 128, like that. I hope, Marvin, you're able to see that. So then go ahead and give me the post-acquisition profit right there, post-acquisition profit. How do we get post-acquisition profit? We take this minus 175. So 230 minus 175. 230 minus 175 is the post-acquisition profit, which gives us what figure? Somebody here, Mary Ann, is giving me 55. So what do we do with that figure? When you get profits, you give the profits to the owners. Please give it to the owners. Share it out. Share it out. Share it out. Share it out. 44 and 11, isn't it? 44 and 11. Share this out. Give it to the parent. Remember, the parent owns 80%. So 80% of 55. The parent owns 80%. So that's 44. And then we have another guy, Ninja, called NCI, 20% of 55, which will give me 11. Thank you so much. So then I hope now this working is clear for everybody. I hope this working is clear for everybody. Then straight away, let's go to goodwill. Let's go to goodwill. So goodwill, so this is the third ninja. Now I'm looking for, the first ninja was Paul. The second ninja is Wani. Now we are looking for the third ninja who will be able to get my today's breakfast. Third ninja. If they get goodwill at reporting, if they get goodwill at reporting, they get my present. No shortcuts, remember. No shortcuts, remember. You get a ninja looking at the answer at the back and they tell us this is the goodwill. No, no, no. No shortcuts. We're above that. We're teaching you ethics. We're teaching you financial reporting. And this ninja called Vero, if she was in class today, because of the idea she gave me, that Mwalimu be giving us these questions we try. Don't do everything. I think I should have bought her also breakfast. I should have given her, but she's not here around here. Or do we appoint somebody to take it on her behalf? And then they share. We shall overcome. We shall overcome. We shall overcome. So now we are doing goodwill. We don't do goodwill for the associate. We do goodwill for the subsidiary. Derek, goodwill is 24. Remember, I want goodwill at reporting. I want goodwill at reporting. What I will be able to report. You guys are financial reporters. You're financial reporters. Is that what we would have reported? Is that what you would have reported? You're financial reporters. Don't forget, you're financial reporters. And today our class will go up to 7 because we must finish the question. Today our class will go up to 7. I hope there is nobody who is working today. I hope there is nobody who is working today. Great. Now, Derek, now you win. Derek, you are a winner. Or somebody has taken the present here. Mary Ann, you forgot to impair your goodwill. There is impairment loss. You can't report 24. You can't report 24. You'll be so wrong. That will be against the dictates of IFRS 10. Goodwill must be impaired. Goodwill must be impaired. Goodwill must be impaired. Goodwill must be impaired. There's an impairment loss given somewhere. There's an impairment loss given somewhere. Not 4 years. 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 So in this case here, we are getting goodwill. Thank you so much. You guys are becoming brighter by the day. You are becoming brighter. Remember, these are the net assets at acquisition. These are the net assets at acquisition. These are the net assets at acquisition. So goodwill, very easy. We have consideration paid by a parent. We have consideration paid by NCI, which is the same as fair value of NCI at acquisition. Fair value of NCI at acquisition, no. Then these are the same. And then you come under less net assets of the sub at acquisition. You get goodwill at acquisition, and then you come under less, in this case here, impairment loss. You get goodwill at reporting. So let's take this approach and then we apply it here. So we shall apply this here. I'll just steal this space. No, you guys, first of all, copy this very fast. Let me know once you finish this. So consideration paid by the parent, how much? Then we have consideration paid by the NCI, which is the fair value of NCI at acquisition. And then we less net assets of the subsidiary at acquisition. We get goodwill at acquisition like that. And then we less impairment loss. Done. We get goodwill at reporting. Thank you very much. So in this question, what do we have? So we have here goodwill computation. So we have consideration paid by who? Consideration paid by who? Paid by parent. How much was paid? Are you able to see the figure? How much was paid? 116. And then we have fair value of NCI, not at reporting, but at acquisition. Fair value of NCI at acquisition, what do we have there? 39. And then we less, in this case here, net assets of the sub at acquisition. Do you remember that figure of 175? Do you remember the figure of 175? Yeah. So come and give us goodwill. Give us goodwill at acquisition. So you take 160 plus 39 minus 175. So 24. Do we have any impairment loss? Do we have any impairment loss? 15, it's given. I'm told not 4. It's given. So you subtract, you get 9. So this is goodwill at reporting. So goodwill at reporting is 9. Very, very good. Then go ahead and give me a working for NCI. No, before NCI, please, we have some income statement item here. This impairment loss is an income statement. This is an income statement item, this impairment loss. Share it out. Share out impairment loss to the owners of the group. So we have here the parent. The parent is 80%. So 80% of 15. So you share these out to the owners of the group because it's a P&L item, this one. So parent gets 80%, which is 12. and then the other owner gets 20%. Share it out times 15, which will give me 3. Share out the impairment loss to the owners. Share out the impairment loss to the owners. To the owners. All right, ladies and gentlemen, that is great. Now from there, I will again keep silent a little bit. We're almost there because you're left with 2 workings only. 2 workings only. Go ahead and give me NCI at reporting. I'll give you 2 minutes. You give me NCI at reporting. Remember, you have NCI at acquisition, but it has grown. It has got its fair share of, challenges here, ups and downs here, ups and downs here. NCI at reporting. NCI at reporting. So I'm waiting to see the answer here for NCI at reporting. Somebody shout figures here. You're working this out. NCI at reporting. So remember, it's about ups and downs. There are bumps there. They have to hit bumps. And they gained immensely. They gained immensely. So perhaps I could do this for you. So in this case here, we have NCI at acquisition. We saw a figure of 39. So we add share of PAP, share of profit, which is PAP. Are you able to remember that figure? Are you able to remember that figure? The PAP, we gave these guys here PAP. Was it 11? Are you sure NCI got 11? NCI got 11, right? So NCI got 11, and you're forgetting that these guys have also gotten a loss. They've gotten a hit. They've gotten a hit. They've gotten a hit here. So we have here share of what here? Share of impairment loss. Share of impairment loss of 3, like that. So 39 plus 11 minus 3 gives me what figure? Yeah, great. So we are getting a figure of 40 what here? 47. So non-controlling interest, Paul Magero, is 47. It's 47. We forgot the impairment loss, yes. They got a share. They got a hitting here. They got a beating here. They got a beating here. Now from there, the last working is investment in associate. For Medoze, the last thing is investment in associate. The last one is investment, and investment in associate is normally, ukishindwa na hii, then you have a problem. You have a problem. Investment in associate, ukishindwa na hii, then you have a problem, especially with practice. If you practice a little bit, then you will always get it right. So investment in associate. So this is normally the easiest. Investment in associate now. So investment in associate, we have here the cost of the investment. So how much? Cost of investment, how much? Please go back to the question. How much did it cost us? This associate called Comic, we paid something. We paid something there. Yeah. 160 and 40% of the ordinary share capital of Comic for 70 million. So we paid 70 million. That is a fair value at acquisition. Cost of investment is 70. But now remember, we have share of PAP. Share of PAP. PAP is post-acquisition profits. And for the associate, we basically look at growth in retained earnings. Growth in retained earnings only. So you give me the retained earnings, in this case here, at the date of reporting for Comic. Retained earnings at the date of reporting. So retained earnings at the date of reporting. Only PAP here. Here in a mambo mingi at your net assets, no. So simply come and give me the retained earnings of Comic. You can see it's 97 at reporting. So 97 at reporting. And then at acquisition, ilikuwa na ngapi at acquisition when we were acquiring this? When we were acquiring this? Yeah. At acquisition is 24. 24, you can see here. You can see here at acquisition, it is 24. 24 Comic and 24. Retained earnings at 24 years. 24, so minus 24. And then, of course, here we take our share only. We take the investor share, and the investor here, the parent here has 40%. So share of PAP here is very, very easy. You look at growth in retained earnings. Look at growth in retained earnings. 29.2. 29.2. Now, ladies and gentlemen, if in this case here we had UPS downward, this is UPS downstream, the parent should not be very happy to have made profits from its investee company. The parent should not be happy that they made profits from, so in this case here, whenever it's downstream, that is the parent has sold to this investee company. That is not very, very good. So UPS down, if it was upstream, that is another thing. But if it's downstream, then we must reduce our investment if it's unrealized. So UPS downstream. So there I would want to remain a little bit silent and to see whether there is anybody who will be able to pick this right. UPS. Is it first of all downstream really? Oh yes, it is downstream. If you look at here on the same date, Laurel is the investor here. Laurel is a parent here. Also sold goods to Comic for cash for 22 million. These goods originally cost 10 million. And the Comic had sold half by the year end. So is there somebody who is able to give me this unrealized profit here first of all? Just try your best, unrealized profit. Thank you so much. Thank you so much. So what we have here as our unrealized profit, of course, will be the revenue they earned is 22 minus the cost here, which is 10, which is 12. But remember, they had sold a half by the end of the year. They had sold a half. So in this case here, the UPS will be, the UPSA, I'll do it separately. The UPSA will be 22 minus that 10, which gives me, of course, 6. But you see, it's not the whole of it which hasn't been realized. Some of it has been sold. So what is remaining is a half. So the profit in this case here, they are telling me is what there? Is it, no, it's 12, sorry. This is 12. 12 times a half is what here? Is 6 like that. 12 times a half is 6. So UPS is 6. But now remember, we only take our, unlike the other one, for the Australia, it's a bit funny. We only take our share. Remember, this is, you take 6 times what here? 40%. 6 times 40%. So 6 times 40% gives me what figure, somebody here? Yeah, I will repeat, but before I repeat, let's just finish. Let's finish. So you're getting here 2 point what here? We are getting here 2.4. So we need to come and do what here? Deduct like that. We deduct. UPS 2.4, we deduct. Is there any other thing? In this question, we don't have any impairment loss in the associate. In most cases, we'll be given impairment loss in the associate. Impairment loss in the associate. Zero, nothing. So remember, if it was given impairment loss in the associate, we normally take the full value. We don't apportion this with the 40%. We'll be able to understand this. So please give me here the investment in associate at reporting. At reporting. So take 70 plus 29.2 minus 2.4. That is minus 0. That's minus 0. They're giving me a figure of 96 point what here? 96.8. 96.8. So this is what you bring here. Investment in associate, 96.8 is what you bring there. 96.8. So remember, investment in associate, according to IAS 28, you start with cost of investment. How much did it cost us to acquire this associate? How much did it cost us to acquire this associate? So this associate, ladies and gentlemen, we are told here, the associate, you can see here, we bought the subsidiary Hardy for 160 and bought 40% of the ordinary share capital of Comic for 70 million. The cost of the investment here is 70 million. So, and then we look at ups and downs of the associate. The first one, of course, there is an upside. These guys made a profit, share of post-acquisition profit. And how do we get to know this post-acquisition profit? You look at the growth in retained earnings. When we bought this associate, the retained earnings were 24. When we bought the associate, the retained earnings were 24. The retained earnings were 24 here. The retained earnings were 24 here. The retained earnings were 24. You can see the retained earnings in Comic at acquisition here were 24. But by the reporting time, Comic has a retained earnings of what here? Check this, retained earnings. Comic has a retained earnings of 97. So the growth here is what we are calling post-acquisition profits here. So 97 minus 44. So we have here 97. We have here 97 minus 24. But now remember, we only take our percentage here. All these things, we normally take our percentage, except what here investment, except this impairment loss. All the others, we normally take our percentage. So we have here, take our percentage, which will give us to 9.2. And you should use your brackets well. 97 minus 24, and you should use your brackets well, times 0.4, it will give us that. And then we have a UPS. UPS normally here is unlike the one of subsidiary, where we have upstream. UPS here, remember you're looking at our investment in our associated company. We normally go down if we do business with our associate, parent to associate, investor to associate. We normally go down. We normally go down. So in this case here, then the UPS will be 6 there. This 6. I hope they are able to remember how we got the 6. How do we get this UPS of 6? It's very easy. We know the profit earned. Remember these guys, in this case here, They sold goods worth 22, revenue minus cost. The cost of these goods was 10. So this gave us a profit of what here? 12, a profit of 12. But you see, out of this profit of 12, these guys had sold goods which were, they sold half of these goods. So half had gone out. And remember, UPS is always based on remaining stock. On remaining stock. It's normally based on remaining. So it will be 12 times a half, 12, which gives me 6 like that. Which gives me 6. So UPS, in this case, here, unrealized profits on stock is 6, but remember to take again your percentage here, which will give you 2.4, and then we don't have any impairment loss in associated dash. That's how we got 96.8. And then remember, for this retained earnings, I know you have now everything. For retained earnings, now you give us the balancing figure. Give us the balancing figure. Retained earnings always give us the balancing figure. Retained earnings, you always give us the balancing what here? Figure. Are you able to remind Mwalimu these figures very fast? Inventory is 608. How about receivables? Receivables, how much do we have here? 441 or something? Receivables, 441. How about in this case here, cash at the bank? Cash at the bank? Cash at the bank, 52. So please give me total assets. Give me total assets. Give me total assets. Total assets. Somebody can give me these total assets. 1589.8. 1589.8. 1589.8. Yeah. Share capital parent only, how much? 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 400. 400. How about share premium? How about share premium? Gitume, 400. I can see that one for share capital. How about share premium? For the parent only. Share premium is for the parent only. 16. Retained earnings. Retained earnings. This will be working. Working. How about balancing? Balancing figure. How about non-controlling interest? You guys are giving me NCI. NCI, you are giving me a figure, NCI 47. NCI 47. And then how about these payables? Payables, how much do we have there for payables? How much do we have there for payables? $800, right? Payables, I'm being given payables of 800. Payables, 800. Payables, 800. I'm being told receivables. Receivables, there is a figure of receivables I'm missing. Paul is giving me a figure of 435 receivables. Is that true, really, Paul? Receivables, check again. Paul, check receivables very well. 275 plus 166. Check, Paul. Unless we have a problem there. It's 441. Check, Paul. 441. So remember then, these things must balance. So we have here 1589.8. So then the balancing figure will be this minus this minus this minus this minus this. What figure are we getting here as our balancing figure? As our retained earnings. What figure are we getting as our retained earnings? They're telling me it is 326.8. 326.8. 326.8. Hii ni working shenzi. Hii ya retained earnings ni hatari. Itakunyorosha. Hii itaki mchezo hii. Haitaki mchezo. Lakini ukifanya hivyo, iko sawa sasa. Unaweka ikiwa ni balancing figure. But if you have the time, which I've never seen, this paper is all about trick. I told you when I was doing it in Casneb, I was the best student during my time. And number 19 globally when I was doing ACCA. So I know at the end of the day, financial reporting, advanced financial reporting is all about what here? Skills of doing the exam. It's not even about technical knowledge, It's time management, basically. But just a proof for group retained earnings. So we start with retained earnings of the parent at date of financial statements. Is there somebody who can pick that figure? Is there somebody who can pick that figure? Retained earnings of the parent of at the date of financial statements? 278. Are you able to see it? 278, 278, 278. And then you add, in this case here, share of PAP. Share of PAP. So share of PAP, we have number one, subsidiary. Are they able to remember those figures? Share of PAP subsidiary. Are they able to remember those figures? Share of PAP subsidiary. Wait, they're not following. They're not following. 44, isn't it? That's number one. And then remember number two, they have an associate. Are they able to remember that figure, associate, share of PAP from the associate? How much were we getting? We had done that working. Was it 12 or 29.2? From the associate, we had done that figure, PAP. Was it 3.6? I think they are lost there. PAP. Remember PAP from the associate, we took, was it 74 minus something times 40%? Remember, you're not talking of UPS. We're not talking of UPS. It is the post-acquisition profit. It was 29.2, isn't it? 29.2. We can repeat it. Let's repeat this. Let's repeat this. Let's repeat this. Remember, we said for the associate, it is growth in retained earnings. It is growth in retained earnings. Post-acquisition profit for the associate. For the associate, we said here, it is retained earnings at the end of the year, reporting date, 97, minus retained earnings at acquisition. So 97 minus 24. And then 40%. I don't know whether they're able to remember this. 40% of that. 40% of that. So is this correct? Please confirm now. Is this correct to 9.2? Is it correct? Is it correct? All right. So from there, go to the UPSS. So we have here the UPSS. So in this case here from the subsidiary, are you able to remember the figure from the subsidiary? The UPSS from the subsidiary, how much? UPS from the subsidiary, how much? 12, eh? UPS from the subsidiary. Was it 12 really? UPS from the, it was 10, isn't it? Just check your figures. Check your figures. UPS from the subsidiary. It was 10 from the subsidiary, from Hadi. And then we have UPS from the associate. We have UPS from the associate. UPS from the associate. Are they able to remember the 2.4 somewhere? 2.4, yes. 2.4. And then we have the impairment loss. Impairment loss, number one from the subsidiary. Are you able to remember impairment loss here, goodwill, which we got from the subsidiary as the parent. As the parent. After we apportioned, after apportionment, it was 12. 12. And then we have impairment loss of the associate, nothing. 0. So these are losses, remember, and unrealized. So if you do it this way, then you'll be able to give us group retained earnings, which will be the same as this 326. 326.8. It's quite a tough working for very many students. Even if they are to bring it like calculate retained earnings for the group, I'm so sure most students here will not be able to pick, but at least you have an idea. You have an idea. You have an idea. You have an idea. But personally, I don't do it. Even now, moving forward in our exams, we shall not be doing it. But at least you have an idea of what is required of us. We have an idea of what is required of us. Thank you so much. It has been a pleasure hosting you this morning. I'm looking forward, in this case here, to meeting you guys. I'm looking forward to meeting you guys tomorrow, same time. Thank you so much. Be blessed. Be blessed. Big time. So the guys, I promised the present. I'll be able to give that present to Paul. I'll give the present to Paul. I'll give the present to Paul, who will be able to distribute to you. Whatever you get, you should not complain of the amount. Don't complain of the amount. Whatever you get, don't complain of the amount. The present, we said Mwalimu will give the present later in the day. Today, he doesn't have M-Pesa here. It will come. You will get that money from Mr. Paul. You will get that cash from Mr. Paul at around 10. Oh, it was very good today, Ruth. Great. All of my classes, Ruth, are good. What do you mean, Ruth, now? Perhaps it's because today you have participated. Maybe the other days, Ruth, you don't participate. Although I like the compliment. Bye. Thank you.